I'm excited to introduce to you our esteemed speaker, Tom Wang, product manager at Wawanesa Insurance. And with that, Tom, the floor is yours.
Thanks, Will. My name is Tom Wang. As Will said, I am the product manager for homeowners insurance at Wawanesa Insurance. Um, I'm very pleased that there's so many people that have signed up for this. Uh, I would imagine that if I were to go out onto the street and ask strangers if they'd be interested in listening to me talk about homeowners insurance for an hour, most people would probably just say, "Get away from me, you creep." But the fact that there's so many of you here today makes me happy, and I thank you for sharing your lunch hour with me and having an interest in homeowners insurance. And hopefully, you'll get something, you'll learn something new out of this. So, I'm going to be going over the fundamentals of homeowners insurance, what it covers, what it doesn't cover. There's some common questions that I come across from people, like, well, why are my rates going up, or why is it hard to find coverage? So I'll try to address some of those towards the end. And of course, if there are questions at the end, we can get to those as well. Um, so let's start off with, why do you need homeowners insurance? Uh, First of all, if you have a mortgage on your home, the mortgage lender uh, will require homeowners insurance. If you own your home outright, then you don't have that requirement. Although I would still suggest you have homeowners insurance even if you don't have a mortgage. It's a good thing. Um, you need homeowners to help pay for damages to your home and belongings in case of some large catastrophic event. It's meant to be a kind of a security mechanism for you, so that in case of um, uh, an unfortunate event, you won't go bankrupt. The insurance is meant to come in and step in and help put you back the way you were before the covered loss occurred. And then also, what a lot of people don't know is homeowners insurance provides some personal liability protection against lawsuits, which we will get into later on. The homeowners insurance policy is divided into two broad sections. One is what we call Section A, and the other section, I'm sorry, one is Section 1, which is property coverages, and the second is Section 2, which are the liability coverages. We'll start off with the coverages for property, which are going to be coverages A, B, C, and D. And then we'll get into coverages for liability, which are coverages E and F. The reason why you have coverage A, B, C, as opposed to just one catch-all coverage, is it's a way for insurance companies to keep track of um, where the dollars are going. It's kind of like an accounting mechanism. So the insurance company knows how much we pay for the dwelling, how much we pay for other structures on the property, how much we pay for contents, and how much we pay for um, loss of use or additional living expense. So the first coverage we'll talk about is coverage A. Um, this covers the dwelling, the actual house itself, not the land that it sits on, but the house itself. And the coverage A limit is the cost of rebuilding the house, or what we call replacement value cost. And this is sometimes confused with the market value of the home. So the market value of the home doesn't really uh, factor into how much insurance you should buy to cover your house. What really matters is how much it's going to cost to repair or replace your home if something bad happens to it. So that's why we don't look at market value. We look at the actual cost of rebuilding. Coverage B is for other structures. So this is outside of the home. You have detached sheds, you have pools, fences, and this is usually limited to 10% of your coverage A limit. So if your home is insured for a coverage A limit of 500,000, then your coverage B would be $50,000 for sheds, pools, and fences. Coverage C is your personal property. It could be your furniture, clothing, belongings. This is typically 70% of coverage A, but it may be adjusted upwards or downwards depending on what you have inside of your house. Coverage D is loss of use. So, should something happen to your house that renders it uninhabitable, um, this would pay for temporary housing. If you have to eat out because you don't have access to your kitchen, if you have to put some of your stuff into storage, it covers that. And the limit for that is 20% of your coverage A. So if your coverage A is 500,000, you have up to 100,000 for coverage D, and that as well you can buy up if you need more of it. On to section 2, liability coverages. So liability coverages have two parts to it. There's coverage E, which is for personal liability. It covers you if you're legally liable for bodily injury or property damage to others while they're on your property. The limits start at $100,000, and you can buy up in usually in increments of 100,000. So if where this might come into play is if somebody comes over and your dog bites them, or somebody is swimming in your pool and they drown. I guess they wouldn't be drowning if they were swimming, but this and those people uh, sued you, then your coverage E would come into play, and um, it does not cover. And this should be kind of intuitive. If you're committing an act of crime on, like your um, if I don't know, you're making a drug deal and it goes bad and somebody gets shot, that's not what this is for. I'll move on to coverage F, medical payments for others. These are for smaller medical expenses that you might incur if somebody gets injured on your property. So if somebody's running around your backyard and they step on a pine cone and twist their ankle, you could um, get money to buy them an ankle brace or an ace bandage or some Bengay. If somebody trips in your backyard and maybe they break their leg or something, it could pay for x-rays at the hospital, a splint or a cast. And the limits on these are fairly low. It starts at $1,000 and you can buy up. So those are the different coverage types of your homeowner's policy. Next, we'll go on to what types of losses does your homeowner's policy actually cover. And I'm going to go over the more common types of losses that we typically see covered by homeowners insurance. First is fire or lightning. And this could be fire due to an electrical short in your house. It could be fire because your house got struck by lightning. It could be a fire because of a wildfire. Um, all those types of fire fire losses would be covered. Wind and hail. This is something that you typically see more in other parts of the country that are subject to hurricanes and tornadoes, which we don't get as much out here. But sometimes we do have some stiff winds out here and occasionally some hail. So in those cases, wind or hail damage to your home would be covered by your homeowner's insurance policy. There is a caveat to that. Homeowners insurance does not cover rain, sleet, or snow directly, but if the wind or hail So if if you leave your door open and it's raining hard and water gets in your house, that's not covered. If there's a situation where the wind or hail does damage to the roof and then the roof leaks and water gets into your house, then it'll cover that. Um, Water damages are covered from sudden and accidental plumbing leaks. They're not meant to cover slow, gradual, constant water leaks over a period of time. So if you've had a, a minor plumbing leak that's been going on for ages, that's not the homeowner's policy isn't meant to cover that. It's more to cover a sudden and accidental uh, leak from plumbing. And as far as rain or weather, uh, water damages from rain or weather generally aren't covered, except for the scenario that I mentioned in the wind and hail above. Homeowners exclusions. What does homeowners not cover? Um, oh, sorry, that's the next slide. We're still talking about what homeowners covers. Um, in addition to fire, wind, hail, and water, it also covers theft and liability. Theft covers loss of stolen property, subject to policy conditions, and liability pays for bodily injury and property damages, as we discussed earlier. Here are common homeowners exclusions. This is what your homeowner's insurance policy would not cover. Does not cover earthquakes, landslides, mud flows, sinkhole, or any earth movement. Some common examples of that would be stress cracks in your slabs, walls, or cabinets due to earth movement, doors being out of plumb, cracks in your swimming pools that occurred due to earth movement. The workaround for this is if you want to be covered for earthquake, you can buy a separate policy that does specifically insure um, earthquake related events. And it's also a good idea to retrofit your home in case of earthquake. So, securing your water heaters and appliances. If you have a raised foundation, bracing and bolting, that is a good idea as well. Another policy exclusion is flood. Your homeowner's insurance does not cover flood. Um, this includes sewer and drain backups, sump overflows, um, underground water damage to the foundation, building, driveway, swimming pools, etc. Um, and the workaround for this is you can buy a flood policy from the National Flood Insurance Plan, which is a um, flood insurance program run by the government. If you're buying a home, probably not a bad idea to check the flood risk of the home before making an offer. These days, sites like Zillow and Redfin have some data in there regarding the risk of flood um, for any particular property. So that's something I always kind of look at if I'm looking at houses online. And then make sure your property has proper grading and drainage so that if we do have a lot of rain, you want to make sure that water is flowing away from your home and not towards your home. And a couple of words on why earthquake and flood are excluded. The reason homeowners insurance does not cover things like earthquake and flood are because when those events happen, it doesn't just wipe out a couple of homes, it wipes out a lot of homes all at once. And insurance isn't built to handle that volume of claims or losses at one time. If you think of it this way, your if you have a $500,000 of homeowners coverage and your policy premium is $2,000 a year, if one home gets totaled for $500,000, that would wipe out the premium of 250 policyholders. So if a few houses in a neighborhood sustain damage, insurance companies can handle that. If every house in the neighborhood gets destroyed by a earthquake or a flood, insurance won't be able to handle that. So some other things that homeowners insurance doesn't cover are long-term damage due to neglect or wear or tear. So this could be stuff like if you just have an old roof or old decking that is hasn't been properly maintained, or it's just old and needs to be replaced. That's more of kind of a maintenance thing, right? That's something that um, the homeowner would be expected to cover themselves, not insurance. Mold, fungus, or wet rot is not covered if it's a long-term condition. However, if you have a plumbing leak and there's some mold that grows in the near term, then insurance would cover the cost of mitigating and removing that mold. And intentional or fraudulent acts are also excluded. So I think that's fairly intuitive. Why is homeowners insurance so hard to obtain right now? Um, there's several reasons for that. A lot of the larger homeowners carriers in the state, who you've probably read about on the news, are either not writing any new homeowners policies in California, or they're non-renewing or canceling some of their existing policies. And the reasons for that is the cost of claims is going up, meaning the cost of repairing your home is going up. There have been uh, challenges from the insurer's perspective of being able to charge enough in premiums, even though it seems like premiums are high. They actually are, from the insurer's perspective, are not high enough to cover the increase in claims that we're seeing due to escalating um, home repair costs, and that's for materials and labor. And finally, there's catastrophe concerns. So everybody has seen wildfires on the news. That's a scary event, not unlike earthquakes and flood. Wildfires don't just destroy one home, they often destroy a lot of homes at once. And that's something that scares insurance companies because we're not equipped to deal with that. Um, yeah. So another question that I get a lot is, why is homeowners insurance getting more expensive? Um, and the short answer to that is, like I said, the cost of repairing your home is going up, cost of building materials goes up, cost of labor is going up, and that leads to um, increased premiums. Insurance at the end of the day is really kind of the the reason insurance premiums goes up really is just because claim costs go up, which means that the cost of repairing your home is going up. Contrary to what some people think, the profit margins for insurance companies don't really go up when rates go up. Our profit margins are regulated by the state. They're pretty heavily regulated, um, and they're fairly consistent over time. So, uh, really, the reason why insurance premiums goes up, it just means that more people are filing claims, and or those claims are becoming more and more expensive to pay out. And Um, some reasons for rising claim costs are, as I mentioned, costs of materials and labor. As as we come out of the pandemic, during the pandemic, we had an interesting time where most people were at home, and we saw a drop in homeowners claims because when you're at home, if something catches fire or there's a water leak, you notice it a lot faster, and you can shut the water off or put the fire out before it gets too big. You can uh, you can address it quickly. But if you're not at home, and once we came out of the pandemic, as people got back to their normal lives and they went back into the office or they started taking vacations again, or they started going to sporting events or concerts again, when somebody's away from home for several hours, uh, a, a plumbing leak or a fire from a candle uh, could really wreak a lot of havoc. The name to the I mean the key um, to controlling the damage to your home is really to be there when the event happens. So if there's a water leak or a fire, which are the two most common types of losses, like the quicker you can jump on it, the less damage it does. Um, Catastrophes, as winter storms and wildfires uh, are becoming more frequent. That's driving up the amount of losses that we pay for those events, and that drives up costs of insurance. And the fourth one is uh, regulators in California decided they would not approve rate increases for insurance companies during the pandemic. And while this seemed like a benevolent gesture, all it did do was kind of prolong or defer the rate increases till later and make them more uh, and make them sharper. So if a company wanted to increase their rates 5% a year, but they weren't allowed to do that for a few years, and then you come out of the pandemic and the regulator starts approving rate increases again, instead of taking 5%, the insurer may need to take 10, 15, 20% to get their rates up to where they need to be. So that's part of why you're seeing a lot of insurance companies increasing their rates, not just a little bit, but a lot. Is a lot of this was kind of pent up rate need from the pandemic. So, what can you do about high premiums? Some ways you can lower your homeowner's premium is you can increase your deductible. Some people have low deductibles of, I don't know, $500, $1,000. More and more, I'm seeing people go towards $2,500 or higher deductibles. So, the deductible is basically how much you pay out of pocket before your insurer steps in to pay damages to your home. And the higher the deductible, the lower your premium goes. You can buy home and auto with the same insurance company, in which case you would get a multi policy or bundling or package discount. This is significant. Most insurance companies will offer you 15, 20% discount if you buy home and auto together with them. So that's certainly one thing to look for. And then uh, finally, you can install protective devices to um, mitigate losses on your home, such as burglar alarm or water leak detection device with an auto shutoff feature. This is something that I would highly recommend. Um, some of those common claims we see these days are homes with plumbing leaks. And if you have, and I have a picture of one of these devices. If you install one of these devices at your home, what it does is it monitors on the bottom left side. That device, which goes on the supply line going into your house, monitors the water pressure So if there's an unusual drop in water pressure, that the device interprets that as a possible water leak in your home, and it can automatically shut off the water to your home in those scenarios. Um, or these devices often come with an app that you can download to your smartphone so that you can see on your smartphone what the water pressure in your house looks like, and um, you can make the determination yourself whether or not you want to shut off the water to your house, and can do that through your smartphone, which is really cool. Um, I think the ability to be able to shut the water off to your home, even when you're not home, is a really valuable thing. Imagine you're at work or on vacation and you get a notification on your phone that something is unusual about the water in your house. Like, you can just hit the shut off and it'll turn the water off to your whole house. And you don't, there may be some leak, but at least you know from the time you hit that shut off button, no more water is going to get into your house. And those devices on the right side are water sensors. They're like these little pucks that you can stick near your toilet, sink, dishwasher, uh, water heater, any appliance in your house that draws water. If you put one of those next to those appliances, it can sense actual moisture or water. And that's probably a more accurate alarm for whether or not you have a leak than the water pressure. So, the thing with water pressure is sometimes the water pressure may just go down because everybody's showering at the same time or something like that. So it doesn't necessarily mean you have a water leak. It just means a lot of people are using water at once. So that sometimes you might get false alarms if you're strictly going off of water pressure in your home. But if you have one of those devices on the bottom right, the sensors, that actually detects moisture or water coming out of an appliance. And so if that gets triggered, and those can be linked to um, your shut off device and app on your phone, so that when you get a positive water leak message, then you have a higher degree of confidence that there really is a leak if you use those sensors. And again, um, I know these things aren't cheap. The device itself costs about $500. A plumber may charge you maybe $1,000 or so to install the device, depending on how easy an access he has to the water lines to your home. If you have a water line that's um, on the side of your house that already has like a lever you can pull to shut off the water, that'll be cheaper to install. If you have to go out to the front of your house and find that box on the sidewalk and lift up that plate and go in with that special wrench or tool and turn off the water from the street, then the plumber will have to run a line from there out to your house above ground so that he can install that device on the bottom right picture. But it's kind of a short-term hassle for a long-term gain that I think is worthwhile. Nobody wants to come home to a flooded out house. Um, and my last slide are some other FAQs that I see a lot. First one is, why did my homeowner's premium go up if I didn't have any claims and nothing changed about my home? Well, there's several reasons your premium may go up this year compared to last year. One common reason is inflation adjustment. Most all homeowners insurers have this, where you'll probably notice the coverage a limit on your policy. Maybe one year it was 500,000 and the next year it went up to 525,000 or something like that. It's generally like a nominal increase of 3, 4, 5% to account for inflation. Another is the insurer is increasing their rates. So and by the way, insurers can't increase your rates without regulatory approval. So it's, as I mentioned before, it's a fairly heavily regulated industry. So if your rates went up 20 or 30%, which is a lot, that means that the insurer had to justify that to the regulator. And that probably means that they've paid out a lot more in losses than they've collected in premiums recently. So they need additional rate. And another more subtle thing is the insurer may have introduced or revised some rating factors. So, not everybody pays the same amount for insurance premiums, depending on where you live. For example, sometimes zip code is a rating factor. If you live in a higher risk zip code, then you have a higher rating factor. If you live in a lower risk zip code, you have a lower rating factor. And sometimes insurance companies, even if they don't increase their base rates, they may increase their factors. So if you happen to live in Beverly Hills and the insurance company decided to change the factor that they apply for rates on Beverly Hills, then Beverly Hills rates may go up, but they might not go up in other areas. The second question, why did my insurer cancel or non-renew my policy if I didn't have any claims and nothing changed about my home? And the answer to this is basically the insurance company now knows more about your property than it did before. And it believes now that your property is riskier than it's willing to insure. So the insurers will, from time to time, revise their underwriting guidelines. Underwriting guidelines are just the rules that insurance companies go by, self composed rules that they go by to decide which risks they will and won't insure. Um, so, for example, if an insurance company has a score that indicates whether a home is of low, medium, or high wildfire risk. Maybe in the past, they insured low, medium, and high wildfire risk, but now they decided they don't want that high wildfire risk. They're only going to insure low and medium wildfire risks. So the people in that high wildfire risk area might see their policies get, non-renewed or canceled. Um, And as I mentioned earlier, that second point to be, um, if the insurer discovered something about your home that it previously didn't know about, such as poor roof condition or excessive clutter, debris around your property, or maybe you have a swimming pool with a giant slide going into it. Um, these days with Google Maps, it's easier for companies to get a visual picture of a particular home and um, and learn things about it that it previously may not have known. So that's it for my slides. We've got some time now, I think, for some questions. If you're interested in getting more information about homeowners insurance or getting a quote from Wawanesa, I've left a number at the bottom there. You can call that toll-free number from Monday through Friday, 8 to 4:30, and somebody would be happy um, to help you out.
Thanks, Tom. Appreciate all that information. So I just want to remind everybody that if you do have a question, please utilize the Q&A function at the bottom of the screen. We'll be happy to answer those questions for you. So we have a lot of questions that have come in, a lot of interesting questions from our attendees. I'm going in particular order. The order I'm going in is the order that they came in. Okay, Tom?
Okay, fair enough.
Okay. One question came in. I don't have a mortgage. How much in home insurance do I need, if any?
The amount that you should get in for your homeowner's insurance would be the cost that how much it would cost to rebuild your home. So all insurance companies have a home valuation tool or tools that they use where basically it's a software you type in an address and it tells you how much the replacement cost is for the home at that address. And it's based on several factors and it's something that can be customizable, but it's based on things like square footage, um, the type of roof you have, the type of finishes you have. Do you have, marble floors versus hardwood floors versus tile versus carpet? Do you have custom kitchen cabinets? Do you have um, significant upgrades to your bathroom, like a jacuzzi tub or a fancy tile shower? So when you call an insurance company up looking for a quote, um, uh, do share as much information as you can with them about any upgrades that you have in your home, because that, yes, it will mean that you're going to pay a little more in premium because you have to buy more insurance, but it'll also ensure that um, when it comes time to file a claim, you will have enough coverage to get back to where you were.
Great. Thanks, Tom. Another question came in regards to San Diego County. Do you cover fire in San Diego County? And do you cover any out of state, anything out of state?
Yes and no. We do cover fires in San Diego. We cover fires. All of our policies cover fire in the state of California. We do not write outside of the state of California at this time.
All right, another question that came in was in regards to who decides whether a home is in a fire area? One member was just downgraded from premium to standard, yet they weren't buying any canyons or forests or anything. So who does make that decision?
That's a good question. Um, Insurance companies typically use wildfire models. What these models are a it's a model created by a group of scientists, insurance professionals, engineers that estimate the riskiness of a particular area for a peril such as wildfire. So there isn't an easy uh, answer as to like how that risk assessment is made. It's oftentimes a score, like the model will uh, will return a score of, say, something from 0 to 100, 0 being the least risky and 100 being the most risky. And your score may be a 40 or 50 or 60. And, the insurance company can tell you generally what factors go into that. Like, are you located near a wildland urban interface? Are you located near a slope? Is there a lot of empty land around you? Is there a lot of flammable vegetation on that land, um, uh, how close are the nearest firefighting resources, how accessible is your property, are the roads very narrow leading into your home so that it might be difficult for fire trucks to get in and out of? All those are things that kind of go into the riskiness assessment of a particular property. And how those scores are actually calculated is usually proprietary. It's kind of like your credit score. Like, you know what goes into your credit score, the components, but what they don't tell you is how is that number actually calculated. Like, you can't go to Experian and say, show me how you got 650 for my credit score. They're probably not going to share that with you, but they can tell you, what factors affected your score. And it's kind of similar to that with our wildfire risks. I hope that helps.
Yeah. How can one find if their home is in a fire zone? Is there like a website where they can go to access plugging in a zip code if they're in a fire?
Yeah. So um, you certainly can do that. The problem is there's different organizations out there that present different views of wildfire risk. So Cal Fire has wildfire risk maps that they publish, but insurance companies also have various uh, models that they use. So it's quite possible what Wawanesa considers high risk is not what another company considers high risk, and it may not be what Cal Fire uh, considers high risk. So if you want to know, what your particular insurance company thinks is high risk, then you have to just call them and find out directly from them. But there are public websites out there that, uh, like Cal Fire, the Department of Forestry, that will give you wildfire risk assessments, and
Mhm.
they have heat maps that show that.
Great, thank you. A few questions about water leaks. What if it's a slow, gradual water leak that's not noticeable right away? For example, the leak is hidden behind the wall. I mean, is that still covered?
Uh, Typically not, but I hesitate to say definitely yes or definitely no on that. If you go by the policy language itself, there is language in there that says it does not cover slow water leaks, and that's regardless of whether it's noticeable or not.
Mm,
Um, so yeah, slow, long water leaks generally are not covered.
mm. Now, the water leak pucks that you had mentioned, where can one buy one? Is there a website?
Yeah, you could Google it. They are available on Amazon, and some big box stores like Home Depot or Lowe's may carry them.
Excellent. And then somebody was asking about,
Oh, you could also call a plumber if you have a local plumber. Chances are
oh,
he's heard about these because a lot of plumbers are installing these devices these days.
great, thank you. What about home hardening? Can you talk about home hardening when we might see that come into play for California homeowners?
Yeah, so the DOI recently asked companies to offer wildfire mitigation discounts. So, in other words, if you take these steps to protect your home from a wildfire, then insurance companies have to offer you discounts. So we have them, as do most other homeowners insurers in California. Right now, they're pretty small discounts because we don't have a lot of data on um, how much less money we're paying out to a homeowner taking these steps. So once we get more data, the discounts will be revised and they may become larger. Uh, but yeah, certainly things like having um, a less flammable roof, uh, clearing brush around your home, um, out from underneath your decks, installing double pane or multi layered glass, not single pane glass, but double or multi pane glass windows in your home. Um, there's there's several steps that you can do, and this is something also that you can Google as well. But you know, what I can say is this: if you live in a high risk area, such as, like, let's say you live in the middle of a national forest, you have a house in Lake Arrowhead or Big Bear, and it's beautiful out there. I can see why people would want to live out there. You're surrounded by trees and nature, but those are extremely high risk, and most insurance companies don't want anything to do with them. If you live in a area that's very high risk like that, even if you clear brush around your house and have a less flammable roof, there's still a good chance if that forest goes on fire, that fire may still hit your house. So um, it's kind of a combination. Like, it's not just hardening your own home, but like the neighborhood around you has to be hardened as well to really be protected from those fires. Because if your house is hardened, but all the neighbors around you haven't hardened their homes, you're still at risk because their homes may catch on fire. And when theirs catch on fire, there's a good chance yours may as well.
Mhm. Thank you. Now we're getting to property coverage, C and D. Is there a minimum coverage, or can you lower or raise it depending on personal preferences?
Yes. So for coverage C, the default is 70% of coverage A. Um, and you can raise or lower that. Um, and as far as coverage D, you can uh, increase that, but you can't lower it from 20% of your coverage A.
Okay. And then someone was asking about solar panels. Someone just got new solar panels. Should those be insured, or should we contact the insurance company to let them know that we've installed solar?
Yes. Um, if your insurance company didn't know that, doesn't know that you have solar panels, there's a good chance your home might be underinsured. So let's say you have a $500,000 home and you added solar panels. So now the cost of um, rebuilding your home may go from 500,000 to 520,000. So yeah, you should call your agent up to let them know that you have solar panels, and then you'll see your coverage a limit go up, um, and there'll be a nominal increase in premium as well.
Mhm. What about fencing? You put in new fencing around the house. Is that something that insurance companies should be notified?
Um, if you think uh, it would cost more than 10% of your coverage A limit to um, repair or replace your fence, should it go down, then you can call your insurer and let them know. So, for example, if your home is insured for $500,000, your coverage B limit, which is for fences, is 10% of that. That would be $50,000. If you think your fence is going to cost more than $50,000 to rebuild, if a wind should blow it all down, then you can call your insurance company and raise your coverage B limit.
Mhm. Makes sense. And you're talking fair market value. How much of that fair market value should your policy cover
Fair market value.
of your home?
So that doesn't really factor in. The relevant value is the cost of repairing or replacing. So in other words, if your home is damaged and it's a partial loss and somebody's got to come out and fix it, then how much would the materials and labor for that be? Um, if your home is completely totaled, how much would it cost to build your home back up from ground up? That's what your coverage A limit should be. It doesn't really have anything to do with the market value of your home. So your home may be worth $1 million, but it may only cost 500,000 to rebuild. And so your coverage A limit should be the 500,000, not the million.
Great. We're running short on time, but we're getting a lot of questions regarding the FAIR plan. And is there a difference between that California's FAIR plan and the supplemental DIC coverage?
Yeah, so Wawanesa doesn't offer the supplemental DIC coverage. What that's meant to do is to plug in some coverage gaps between your homeowner's insurer and the FAIR plan. So the FAIR plan, uh, the good thing about them is they'll insure any home, even if it's a high risk home. The bad news about the FAIR plan is the coverage isn't as comprehensive as you would get on a regular homeowner's policy. So, like the coverages B, C, and D that I mentioned earlier, those are either uh, limited or not available in the FAIR plan. Um, and the difference in conditions is meant to, so let's say the FAIR plan uh, doesn't um, doesn't have liability coverage like your homeowner's policy.
Mhm.
So a company may, as part of their difference in conditions, offer liability that you can buy in addition to the FAIR plan to kind of get you to where you would be if you had a homeowner's policy.
Okay. What about cracks in the foundation? Are insurance companies insuring homes that have cracks in the foundation?
Generally, no. If the crack, well, it depends on, I guess, the cause for the crack. If there was an earthquake or some kind of earth movement, those are explicitly excluded from coverage on your policy. So the homeowner's policy would not uh, cover a crack foundation in that instance.
Mhm. And the last couple of questions are related to flood. How do we find out if we're in a flood zone? How much on average does it cost to add flood policy? And could you speak a little bit more about flood insurance?
Sure. To, First of all, if you have a mortgage on your home and you're in a flood zone, then your uh, bro- mortgage lender will likely require you to get flood coverage. Um, Outside of that scenario, you can do a search online. Um, you know, I did this myself. I just Googled how to tell if my home is in a flood zone, and there's various sources that come up that will give you an idea of relative risk of flood to your home. Um, but uh, yeah, there are, as I mentioned before, some of those real estate sites like Zillow or Redfin, they have some flood risk information in there that they kind of get from uh, other third party sites. So yeah, I would suggest uh, googling um, googling that, and you can find out more information as to whether your home is in a flood zone, or you can contact an insurance company that writes flood for the National Flood Insurance Plan. The National Flood Insurance Plan uses regular insurance companies as sort of their agents. So you buy the flood insurance through your regular insurance company, and they in turn uh, shift that risk over to the federal plan. So basically, the insurance company is kind of the middleman. They will collect the premiums and pay losses. But at the end of the day, whether or not the flood insurance is profitable or unprofitable, that falls on the federal government.
Mhm. Mhm. Great, thank you. Tom, thank you so much for all that information. There were a lot of questions we couldn't get to, but there's an 800 number there that if you have any questions, feel free to call Wawanesa for those questions. Feel free to follow us on Facebook, Instagram, X, and of course our YouTube channel, Calco CU. We sincerely hope that you've gained some new and valuable insights today that you can apply to your financial journey. Your presence has truly made a difference, and we appreciate you taking the time out of your busy day to join us this session. Until we meet again, wishing you continued success on your path to financial well-being. Have a happy holiday.